we want to do this, buy this real estate deal for $300K. I've got $100K in my IRA. My spouse has $200K. We can't do it separate, but if we go in together, we could do it. Great.
This is why we do this. And we pool our money together, and it's exciting. It's not that complicated. Some of you are doing this with several hundred grand, several million, or several 10,000s, whatever. Do what you love.
Yeah, we're going to get creative today and talk about how your IRA can partner with others in deals. Your IRA may be the cash partner in a deal and someone else is the work partner in a deal. How do we structure that? Maybe it's your IRA, your traditional IRA, your Roth IRA, your spouse's IRA, your HSA, your kid's Roth IRA, your ESA. Maybe I can put all those accounts, combine the funds into one LLC to do a type specific deal or transaction. So we're gonna go over those rules, kind of the options, common structures we see, and things you can't do.
Yeah. Can I start with that?
Yeah.
I think let's just come right out of the gate and say this. When we say partnering with others, it's not selling your LLC owned by your IRA to a family member. Yeah. It's coming together. I like how Matt said combining.
Co-investing.
It's co-investing at the front end of the deal.
Yeah.
If you're already in a deal with your retirement account or you're in a deal personally, combining that in a structure to self-direct is nearly going to be impossible because the train's already left the station. So this is, there's a little analogy of metaphor, is you're in the train station now and you're buying the ticket. Who am I going to sit by? Where are we going to go? And let's get on this train. This is going to be awesome. And so that's when you're having that conversation is when you're buying the train ticket, and then we're going to all aboard and go. If the train's already left the station, you've seen that. It's not pretty. People trying to jump on a train after. I mean, it can be exciting. You need a stuntman for that.
Yeah, it could be tragic. There could be some, prohibited transactions happening there at the train stop. So, and that's really what we're talking about here is basically your IRA can't transact with you personally. It can't buy or sell something. So if I have an IRA that owns an LLC 100%.
Well, the train's moving.
Yeah, well, that train's moving now. My IRA owns it 100% now, and I've already done that. I can't have my spouse's IRA come in. I can't personally come into that LLC because now I got to buy some of that ownership from my IRA. Now I'm transacting with my IRA. But if my IRA and myself are at the train station at the same time, or my IRA and my spouse's IRA are sitting there at the train station, we say, hey, let's go do this together. Let's get on the train together and go do this investment. And you're like, all right, my IRA will put in 50K. My spouse's IRA puts in 50K. Let's set up the LLC from the very beginning, 50-50. Now that LLC can go out on the train. We're going to go do this deal that's going to take $100K to do. And so that's a classic example of what's very common actually, is multiple IRAs coming at the very beginning. They're not transacting between each other. They're co-investing at the same time, taking an allocation of ownership based on the dollars they're putting in, and now we're going out to do a transaction. And sometimes, I get clients like that. They're like, hey, Matt, we want to do this, buy this real estate deal for $300K. I've got $100K in my IRA. My spouse has $200K. We can't do it separate, but if we go in together, we could do it. Great. 1/3 to your IRA putting in $100K, 2/3 to your spouse. Let that LLC go and buy the property for $300.
I love it. And what you're going to hear out there is a lot of misinformation. People that are like, well, you can't do deals with your IRA. You can't do a deal when the train's already left the station. And they don't know, or they don't clarify what they're saying. My IRA can't do a deal with family, or I can't do this or can't. Well, again, that's on day 2. But we're on day 1. We're planning, we're coming together. And the law, the IRS, the case, all of the rules out here under ERISA say it's okay if you're planning at the out front of this. When someone says you can't do a deal with your IRA, know that they mean a deal that's already underway. We're talking about doing deals before the deal is embarked upon.
Yeah. Next, what I want to talk about though is, what if it's just other people? How do I use my IRA with my friend or some other investor? There's other structures to do there, and frankly, it's simpler. So we'll come to that here in a second because the rules are different.
Yeah. I'll give this first piece of advice, and that is kind of have in mind a plan before you start embarking on these conversations with either family or friends. We do want to do real estate, or we want to do crypto, or we want to do notes. Have a general plan so that when you're collaborating and bringing your people together, they feel like there's some good leadership there. They're not nervous. It makes sense.
Oh, love that. So let's go over a few examples here. I think it'd be helpful to conceptualize this in like some scenarios, because Mark just rattled off some factors to think about, and those really end up in being some of the classic examples we see. LLC. The first one we kind of mentioned a little bit earlier is maybe it's a real estate deal that's $300K, and I said earlier, and we need maybe my Roth IRA, my traditional IRA, my IRA, my spouse IRA. Let's combine a couple retirement accounts into an LLC to do that deal. That's very common. That's going to be called a multi-member IRA LLC. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. This is a little more tricky than a single member IRA LLC where your IRA owns at 100%, okay? So when we're doing this multi-member IRA LLC where it's your IRA and maybe your spouse's IRA or some other disqualified family member, we've got to go in at the same time. We break up the ownership based on the dollars invested. It's going to cause a partnership tax return. It's not a single member LLC where there's no tax return to the IRS. There's going to be a partnership tax return for this LLC. There's no tax due, but you do need to file a partnership tax return to 1065. And then also when money's going in and out of that LLC, and let's say it was 1/3, 2/3 when you set it up. Your IRA put in 100K to that LLC, spouse's IRA put in 200K to the LLC. Your IRA is going to own 1/3, your spouse's IRA is going to own 1/3. Well, let's say there's $10,000 of profit you want to get back to the IRAs from the LLC. $3,333 is going to yours, $6,667, let's say, it's going to go to your spouse's, okay? It's going to be broken down based on the dollars invested. Let's say you need to put in $10,000 more to the LLC to cover an AC unit that went out you didn't expect or whatever. Well, you're going to have to fund that 1/3, 2/3. Your IRA would put in $3,300, spouse IRA would put in the $6,600 and change, okay? So anything going into that LLC and out, that ownership's fixed. It's got to go in based on the ownership percentage. It's got to go out based on it, okay? So that is sometimes a downside. So I don't want you to think of this as technically a thing I'm going to put money in every year. It's going to come out every year. Most people, in the first example I gave there, are saying, hey, let's get the money in there we need. Let's go make the investment. Let's make sure there's enough in there so we don't need to put more money in later. Let's let that thing cash flow, appreciate. Maybe there's some income coming to the LLC. Let's go make a new investment from the LLC. You could go buy a new asset, okay? Or maybe we send it down to the IRAs if we want to do other things with them at the IRA level. That's certainly possible too. So that's option one.
I like it. Now, one other real example. I'm in week 2 of this right now.
Right.
I actually turned on my computer and didn't plan on talking about this, but about 2 weeks ago, Patty and I are meeting with a rancher in Heber City, Utah that said, hey, if you buy some cows, I can put them on my land and I'll take care of them and graze them. And next year you can sell the calves that that are born this year, and then we'll start the process over, rinse and repeat, And so we thought about it, and we had our health savings accounts with enough money that if we combined them, we could pull this off. So 2 weeks ago, we cut the deal. We had a plan. The rancher's like, okay, you're going to buy 10 bred heifers, which would cost about $3,000 a cow that's already pregnant, and in the next month they're going to give birth to 10 calves. So you're going to have 20 cows at the end of the process. So we put together a budget of how much to buy these. That's $30,000. Then we need operational costs to get us through the year. With combining our 2 HSAs, see, you don't have to have thousands and thousands of dollars to do this. This was fun for us. But by the time we combined our money, mine, I'm looking at it right here, had 77% in units, and Patty had 23%. Because it was pro rata between the money we put into it, and we formed the LLC in the state where we're doing business. Meanwhile, I called up Directed IRA and said, hey, I need to have my HSA liquid because we're going to go invest in this LLC. And they're like, okay. So simultaneously, this is the important point. Find the account you want to use. You got your plan. Make sure it's ready to go with the cash. Your partner, your spouse, whoever you're going to get to partner with you, they're pooling their money. Get them at Directed IRA, get them on the chat, call, whatever, open the right account. Meanwhile, you're getting your LLC going. Be working on both of these at the same time. These cows are going to weigh between 800 and 1,000 pounds next March. They're selling for about $2,500. So if I don't have any cow die on me, I'll have 10 cows to sell 1 year from now. And I'll have pregnant cows again. So those 10 cows should sell for about $25,000. Now it cost me $12,000 to $18,000 to maintain them during the year. I still have my original moms that are pregnant again. So now I'm at a profit margin, worst case scenario, of about $7,000. $7,000 divided by original investment of 30, I'm at a 23% ROI. 23%, worst case scenario. And if I can make a 20 to 30% return, this
Yeah.
is why we do this. And we pool our money together, and it's exciting. It's not that complicated. Some of you are doing this with several hundred grand, several million, or several 10,000s, whatever. Do what you love.
Yeah, and this is what self-directing is all about. You get to choose the investments. Now, real estate's going to be the most common, right? And there's other assets. This could be crypto, So these are the types of things you can do. The concept for today, of course, is how are you partnering? Mark and Patty are partnering their HSAs. This could be their Roth IRA, their traditional IRA. Doesn't matter, but we're combining multiple accounts. We break up the ownership. You go in at the same time. Okay, and then when these cows sell to that LLC that you've got, Mark can keep doing that. That LLC can keep doing the next deal, right? And it can keep getting that 20% ROI or whatever he hopes to get. And that's a great example right there. Let's talk about the second example that I see that's common. I've got 50,000 in my Roth IRA. My spouse has 50,000 in theirs. We want to go in 50-50 into an LLC. And then every year we want to be dropping in our 7K a year into this LLC as well. Or maybe it's brand new 4 Roth IRA accounts. It's mine, my spouse's, 2 of my kids. They got kids Roth, they got income, and we're gonna be dropping in 7K a year and reach 25% in that LLC. So I do see sometimes families or spouses where they go in at the same amount because they want to do the annual contribution and get it into the LLC. Now, if you're doing that, I want to go over a couple of things. One is that could be a great strategy. Sometimes I'm like, just do your own investments, do your own IRA LLC 100%, have your spouse do their own. You can do your separate investments anyways. Some people are like, no, we want to go in together. We don't have enough money to do the deals we want to do, but if we combine, it's going to be much more easier, better deals, better opportunities. When you're doing that annual contribution each year, 2 things you got to remember. One, you go in based on dollars invested. So if you're 50-50, you each need to put in the exact amount. If you reach 25%, again, equal ownership, everyone's putting in the same amount to keep their equal ownership. And 7,000 is the annual contribution. Now, if someone's over 50 and someone's not, they can't do the 8,000, the other person does 7. The other thing is you don't put the money in the LLC. You don't own the LLC. The IRA does. You make contributions to the IRA, and a directed IRA, you tell us, all right, now put the additional money as an additional investment into the LLC. So just make sure that's sometimes a common mistake. People are like, well, I just put money in the LLC. You don't own it. Your IRA does. Well, it's my contribution. Well, your LLC's not tracking that. Are you reporting from your LLC to the IRS your annual contributions to your IRA? No, you're not. You've got to go through the IRA custodian. So make sure you get the money to the IRA, and then the money goes from the IRA to the LLC. Same thing when you take money from the LLC. You don't take money from the LLC. You don't own it. It goes back to the IRAs based on their percentage of ownership, and then you could take a distribution from the IRA, which is, of course, something you do later on in retirement.
Let's go to the non-family. I think with the non-family, it opens up another option, and that's where you have service partners.
Yeah.
Which gets really exciting. So in our situation with Patty and these cows, sticking with that example, we can't go work on the cows. We can't eat the cows. We could go pet them maybe, but we cannot work on the ranch with our HSA cows. That would be prohibited. Now, we might buy cows from this rancher that are very similar down the road, yada, yada. But the point is our HSA cows have to be sold to someone else and managed day to day by someone else. Well, let's say the rancher's like, hey, I love what you're doing here, guys. Bring me in for a third, and I won't charge you anything. I want to share in the profit by a third, and now you can cut down on your operational cost, and I'll just be a working partner. You guys pay for the cows. I'll find the land. I'll pay. I'll pay for the vet. I'll do everything throughout the year. And you know what? You guys will make more. And I'm excited because I want to be a part of the process. I think we could do more because I'm going to be more vested in this, whatever. And it could be a real estate deal. Someone that's like, hey, I'll do the fix and flip labor. You guys pay for the house with your retirement accounts. And again, it allows you to maybe get in a bigger deal because you didn't have enough money to capitalize the whole deal without having to pay for someone to work it. Now you get the worker for free because they're earning equity on it. So, but you can't do that with family. So this opens us this whole new door that you can still work with family on the co-investing, but the labor has to be a non-prohibited party. And again, another aspect that could be a really big win-win-win.
Now, one other variation of this, though, is you can be a cash partner personally in an LLC with your IRA. So you could say, well, I've got $100K of personal cash and, $50K in my IRA. I'll take 2/3 of an LLC and my IRA gets 1/3 or 50-50 or 80-20, whatever it is. But we can do that as well where your IRA is a cash partner with you because we're breaking up ownership and value solely based on dollars. There's no unfair benefit going one way or the other. We're strictly doing it on the cash, but you can't get ownership for just doing work or finding the deal person.
Yeah, I want to repeat that because that was a big reveal here in this podcast is, yes, you heard it right. Let's say it's Patty and I that are doing this, again, the cows. My HSA puts in money, her HSA puts in money, I put in money. After tax personal money, she puts in personal money. Now we have 4 partners, but we raised twice as much money. Now we wanted to do the whole deal in our HSAs because we wanted this profit to go back to the HSAs and buying more than 10 cows, ultimately 20 here in the next month or two. But we could close down the LLC and start fresh. And that could work too. But the point is you can put in money, not labor, and still be a partner in that LLC. Last point I'd make here is bringing this maybe full circle is this is not one to be embarked upon lightly. This is not you playing around with your software, creating the LLC. Get your partners that you want to work with on a call all together with one of the tax lawyers. We would represent the entire group. You don't need competing lawyers and expensive partnership agreements and all that crap. It's one LLC, one tax lawyer, bringing everybody together on a Zoom call and answering their questions. You look like a superhero because you were smart enough not to play lawyer on TV.
Yeah.
So you get there, bring the team together, the lawyer will lay it out on a red carpet, boom, you're in business before you know it. You start trying to play lawyer, you're going to F it up.
Yeah, and our attorneys at KQS Lawyers do this every day. They've got all the reps in. They've been trained by Mark and I. They all know what you can do and can't do, how to structure this properly. We've got the right operating agreement that's got the right provisions in here, whether you're using directed IRA or any other company. You got to make sure that it's got the right provisions in there. And so we've, of course, got a team here that knows how to do this and can take care of it. There's other lawyers and other professionals that could certainly help you, and feel free to use those. Make sure they know what they're doing. But we're certainly a resource. And the multi-member IRA LLC, we charge $1,500 at our law firm, plus the state filing fees. And then, of course, you got the IRA account costs too. Depending on how many accounts you might have, there'll be an annual fee for those accounts. So when you're coming over here, we're going to say it's likely you're going to need to talk to a lawyer, and almost certain to get it done right. Because, but you might use this structure for 10, 20 years, and it could be the same freaking structure. And so this might have a little upfront cost, but over time, it'll be a valuable structure you're going to be using to investing in the assets, combining these different accounts and resources you might have to have greater opportunities and possibilities. So it could be a really huge benefit for you.
Well, thanks, everybody. We hope that we are unlocking your American dream. This is an exciting, exciting time where the retirement accounts are more unlocked, more clarity on what you can and can't do than ever before. And the theme, our slogan has always been invest in what you know. And we want to help you do that. So this is a great way to pool money, get more capital, get more creative, and get people in the project that you need, whether it's service or their money. So we wish you the best. We hope that our information is super helpful. We're not going anywhere. We'll be here again next week talking about real strategies and self-directing. And we have an entire team at the company that can help you at any moment. So thanks, everyone, and we'll see you next week.